into a quick little live video on as the Federal Reserve have just voted to lower the Fed funds rate by a quarter percentage point. So it looks like, as I'm reading the Federal Reserve release, it looks like all of the board members but one voted in favor of this Fed funds decrease. The only member that I see that voted against it was Beth Hammack, who preferred to maintain the target Fed funds rate at 4.5 to 4.75%. So a couple things jump off the page at me. Earlier this week, LinkedIn released some data or highlighted some data how consumer spending and retail spending is actually up year over year when they were comparing the different months. And we also obviously have Bitcoin continuing its massive rise with MicroStrategies now being added to the NASDAQ 100 index. That's going to continue to drive that north as this speculative bull market continues to run. We'll see how much is left on that. But in terms of, you look at cryptocurrency, gold, silver, the NASDAQ, S&P, Dow, all at all-time highs. I'm so intrigued by the fact that we are lowering interest rates when all of those indicators are the economy is running hot. So the Fed has been pleased recently. The labor data has been coming back stronger than they were thinking. They were worried very much so that unemployment was massively going to rise, which is why they're cutting rates. They're still ultimately worried about the unemployment numbers, but me personally, I'm a little confused by the fact that we're lowering interest rates here. I continue to see speculation at massive numbers, and to me, as you guys know at home, I think the stickiest part of inflation that we're feeling right now is wages. And as we continue to cut rates, that is going to have effects through the entire economy. So as you lower interest rates, you are going to continue on more of those discretionary assets. For you guys that follow the channel, you know I'm about the staples, and it is long overdue that the consumer staples matter again. It has been a discretionary 15-year massive run-up, and it is time for the staple economy to matter again. So it will be interesting to see where this goes, and see previous videos on this. But the Federal Reserve also only has so much gunpowder left. As you guys know at home, borrowing costs are really based on the 10-year yield. So the yield on that 10 years is what's driving the average consumer's borrowing costs. So we've talked a little bit on this channel how with China changing up some of their plans and Japan changing up some of their plans, they are not buying near the U.S. treasuries that they used to. In all honesty, China is actually going back to the well and printing even more money. That's a debt crisis and a different conversation. But it's going to be really interesting and intriguing to see how the Fed's able to bring down borrowing costs when they want to, because with sovereign countries getting out and not being the main buyer of treasuries, as more investors and retail investors buy said treasuries, they're going to want a higher yield on that investment. The higher that yield goes, the higher the borrowing cost is going to go for your average borrower. So really, in my opinion, interesting times of where we're going to go forward. The last real big caveat is China, for the first time in their country's history, has actually written a note in US dollars. They gave the Saudis a $2 billion loan backed in US dollars, not the yen. So it is going to be, not the yuan, sorry. It is going to be very interesting, again, with these different countries all trying to figure out where we're going to go. Is it going to be BRICS? I don't think so. Crypto's had that run that we're talking about, but again, really just from a macroeconomic standpoint, super interesting times. And just I'm going to be curious where the interest rates end up going from here. So yeah, I see some comments. Thank you guys. Hey, I appreciate the support. I appreciate the support. Where do you guys think interest rates are headed? What do you guys think the next 6 to 12 months look like? Are you guys surprised the fact the market was actually baking in that they were going to lower interest rates at this meeting? So it's not I wouldn't say investors were caught off guard. The market was baking on an interest rate cut. It's just, to me, it doesn't line up with the indicators that I continue to see. And if I am right in where labor is the stickiest form of inflation, cutting this 25 basis points is not going to affect inflation in the slightest. The two things that massively do: energy prices and wages. So those are the two stickiest forms of inflation. So we will see where this goes. I appreciate all the comments this time, guys. I will do more live videos as we move forward. But thought with the breaking news of the last hour or so, wanted to hop on here and do just a quick little video recapping the decision by the Federal Reserve to lower the Fed funds rate by a quarter basis point today. We'll see. I think they have, that's their last meeting of this year. And I think the market is baking in 3 interest rate cuts next year. But again, we will see. The Fed calls themselves data dependent, but sometimes I think it's interesting the data that they're choosing to look at. So thanks for everybody's interest and support. Comment down below what you guys want to learn more about, and see us on the next video.